Welcome to our channel. Today, we're diving into a topic that's been making waves in the housing market, the effects of Wall Street buying homes and raising extremely high vacancy rates in some places. As we explore this issue, we'll uncover how large investment firms have shifted their focus from traditional stock markets to residential properties, fundamentally altering the landscape of home ownership. In recent years, Wall Street has poured billions into buying single-family homes, often outbidding everyday buyers and turning these properties into rental units. This trend has not only driven up home prices, but has also led to a significant increase in vacant homes, leaving many communities struggling with the consequences. With extremely high vacancy rates soaring to alarming levels, it's crucial to understand how these dynamics affect not just the housing market, but also the lives of everyday people. Throughout this video, we'll break down the implications of these investment strategies, examining how they contribute to housing shortages and impact local economies. We'll also discuss why it's essential for viewers to grasp these market dynamics, as they play a pivotal role in shaping our communities and future housing opportunities. So, whether you're a homeowner, a potential buyer, or simply curious about the housing market, stick around as we unravel the complexities of Wall Street's influence on residential properties and what it means for all of us. Let's get started. In recent years, Wall Street firms have made a significant entrance into the housing market, fundamentally changing the way we think about home ownership and investment. These firms are motivated by the potential for high returns in a market that has historically been seen as stable and lucrative. By leveraging financial strategies such as bulk buying and securitization, they can acquire large portfolios of residential properties, often at prices that outpace average buyers. One of the primary strategies employed by these firms is the purchase of single-family homes, particularly in suburban areas where demand is high. They often target distressed properties or those in emerging neighborhoods, aiming to renovate and rent them out. This approach not only generates steady cash flow through rental income, but also allows these investors to benefit from property appreciation over time. Additionally, some firms are investing in multifamily units, further diversifying their portfolios and maximizing their returns. However, the implications of these investments on local housing markets can be profound. As Wall Street firms buy up homes, they drive up prices, making it increasingly difficult for average families to enter the market. This can lead to a decrease in home ownership rates and an increase in rental demand, which in turn can inflate rental prices. Communities may also face challenges as extremely high vacancy rates accumulate, leading to neighborhood decline and reduced local investment. The surge of Wall Street investment in residential properties has created a ripple effect that significantly impacts the overall housing supply. As these firms aggressively purchase homes, particularly in desirable neighborhoods, the availability of properties for local buyers diminishes. This correlation between increased investment and reduced housing availability is evident in many markets across the country, where everyday buyers find themselves outbid and priced out of the market. The concept of housing scarcity becomes increasingly relevant in this context. With fewer homes available for purchase, competition among buyers intensifies, driving prices upward. This scarcity not only affects home ownership opportunities, but also places additional pressure on rental markets, as more individuals and families are forced to rent rather than buy. Consequently, we see a rise in rental prices, further exacerbating the affordability crisis in many areas. To illustrate the impact of Wall Street's buying spree, consider statistics from cities heavily affected by these investments. For instance, In certain neighborhoods of Atlanta, the number of homes available for sale has dropped by over 30% in just a few years, while home prices have surged by nearly 20% annually. Similarly, in Phoenix, the influx of institutional buyers has led to a 25% increase in median home prices, making it increasingly difficult for local residents to find affordable housing options. Understanding these dynamics is crucial for grasping the broader implications of Wall Street's role in the housing market and the challenges it poses for local communities. The phenomenon of extremely high vacancy rates in areas heavily bought by Wall Street is alarming and has profound implications for local communities. An extremely high vacancy rate means that the vast majority of homes in a neighborhood are unoccupied, which can lead to a range of social and economic challenges. When homes sit empty, it not only signifies a lack of investment in the community, but also contributes to a decline in neighborhood vitality and cohesion. Extremely high vacancy rates can have dire social consequences. They often lead to increased crime rates, as abandoned properties can become hotspots for illegal activities. Additionally, vacant homes can deter new residents and businesses from moving into the area, stifling economic growth and development. The psychological impact on remaining residents can also be significant, as they may feel isolated and less secure in their community. Examining case studies reveals the stark realities of neighborhoods grappling with these issues. For instance, in parts of Detroit, where Wall Street firms have purchased large numbers of homes, extremely high vacancy rates have soared, leading to a decline in property values and a rise in blight. Similarly, in certain areas of Cleveland, the influx of institutional investors has resulted in a significant number of vacant homes, contributing to a sense of abandonment and disinvestment. These case studies highlight the urgent need to address the consequences of extremely high vacancy rates and the role that Wall Street's buying spree plays in shaping the future of our communities. Understanding these dynamics is essential for fostering healthier, more sustainable neighborhoods. The actions of Wall Street in the housing market could have significant long-term effects that reshape local economies and communities. As sustained investment continues, we may see a fundamental shift in the dynamics of homeownership and rental markets. With institutional investors dominating the landscape, the traditional notion of homeownership could become increasingly elusive for many families, leading to a generation that relies more heavily on renting rather than owning. This shift is likely to drive rental prices higher as demand for rental properties increases while the supply of affordable homes dwindles. In many markets, we are already witnessing this trend, where rental prices have surged alongside the influx of Wall Street investment. As a result, families may find themselves allocating a larger portion of their income to housing costs, which can strain budgets and limit spending in other areas of the economy. To mitigate these negative effects, potential policy responses must be considered. Local governments could implement measures such as rent control or inclusionary zoning to ensure that a portion of new developments remains affordable for low and middle income families. Additionally, policies that encourage the construction of affordable housing could help balance the market and provide more options for residents. Ultimately, understanding the long-term consequences of Wall Street's actions is crucial for developing effective strategies to protect communities and promote sustainable housing solutions. By addressing these challenges head-on, we can work towards a more equitable housing market that benefits everyone, not just institutional investors. As we wrap up our discussion on Wall Street's influence on the housing market and the concerning extremely high vacancy rates in certain areas, it's essential to recap the key takeaways. We've explored how institutional investors have shifted the landscape of homeownership, driving up prices and reducing availability for local buyers. This buying spree has led to alarming vacancy rates, which not only affect property values, but also have profound social and economic consequences for communities. The implications of these trends are significant. As more families find themselves priced out of home ownership, the reliance on rental properties increases, leading to higher rental prices and a potential decline in neighborhood vitality. Understanding these dynamics is crucial for anyone invested in their community's future. We encourage you to reflect on how these issues might be impacting your own neighborhood. Are you seeing changes in housing availability or rising rental costs? Engaging in these conversations is vital for fostering awareness and driving change. If you found this video informative, please consider subscribing to our channel for more content on housing market dynamics and community issues. Don't forget to like and share this video with friends and family who might also be interested in understanding the complexities of the housing market. Together, we can raise awareness and advocate for solutions that benefit everyone in our communities. Thank you for watching, and we look forward to seeing you in our next video.